Focusing on the Sintex Industries, numbers came in line with estimates. Net sales were down close to 2.5% and the net profit was clocked in at 81.6 crore rupees. That's down 27% on a yearly basis. We've got Mr. Sunil Kanodia, who is the Group President at Sintex Industries, to talk more about the numbers in greater detail. Thanks very much for joining in on the show. Mr. Kanodia, the Q3 numbers for your company was largely in line with what we were expecting, but margins came in 150 basis points lower. What key reasons would you attribute for that?
See, I think we have to look at the overall macroeconomic situation unfolding around us. There are three factors which determine, bit of growth taken at a lower level because we moderated it ourselves. One is the exchange rate because it has an impact on the liability that we have on the FCCB. Second is the interest rate peaking. And third is the slowness that's happening in the Indian economy, and especially with the government business because there is an inactivity around that. Now, monolithic happens to be one of the major segment of the business, and that is one segment which consumes a lot of working capital. And we found that because of slowness and inactivity from the government side, the checks were not being released and the working capital cycle was enhancing. And we did not want that situation to happen. At the same time, the custom molding segment in the overseas market was also getting a little bit flattened because the European economy is going down. And thirdly, the cost of interest is also higher. So considering all those things, I think the prudence required us to look at it holistically, and we wanted to then improve our balance sheet numbers so that at the time when FCCB comes for redemption, we have enough cash conserved to be able to pay back, and we have minimum of debt to be taken at that time for the redemption. So these were some of the objectives that we worked towards moderating the growth. I mean, going by the order book on monolithic, we still have the orders. If we go ahead in terms of executing it, we can achieve probably our numbers. But that's not the objective right now. I think we have to look at the balance sheet as well.
You open to raising money, via the strategic or via the PE route?
See, if there are two routes, I mean, one is the equity route, other is the debt route. But looking at the stock price today, equity route will attract a huge dilution, and I don't think that is prudent for a company to go ahead and do it. Therefore, we have to look at the debt route. I mean, out of 225 million of FCCB and considering the YTM of 5 years, it would be about 280 million as the total liability, out of which 110 million is lying overseas in dollars. So that's naturally hedged and cash available. Balance, we are talking about 140 million or so, out of which I guess 40 million or so we will be able to arrange within the company through its internal accruals as well as raise, through the subsidiaries debt. Balance 100 or 110 depending on the exchange rate, we will look at ECB as one of the options at that time.
Sure, and we believe that specifically for the monolithic business, there was a significant slowdown in payments from the government. What is the total outstanding that is due from the government?
I don't think I will have the figures. All I can say is that the working capital cycle, which was about 110 days or so, was going towards 125 days or so. So we got little warranted, and therefore we moderated the growth.